Hello, everyone. Welcome to this video about Alibaba. This is actually a company that we invested in about 2 years ago, and we recently decided to make a new investment. So we wanted to create a video on the company and our decision to invest again. So with that being said, let's jump into the presentation. Okay, so as I just mentioned, we first invested in Alibaba about 2 years ago in September 2021 at around $164 per share. And we first became interested in the company because Charlie Munger had invested. And we believed it was a good company, but we did get swayed by the fact that Munger had invested. So our opinion was biased from the beginning because we kind of wanted to make an investment before we had even started analyzing the company. And we mentioned in our recent ASOS video about how listening to gurus got us into trouble. And this was kind of similar, but we don't think it was as bad as ASOS. And between the Alibaba investment 2 years ago and now, we developed our new investing system that we have covered in several videos. So we therefore recently decided to take another look at the company because the share price had fallen a lot, and we wanted to approach the company with a fresh pair of eyes. So with that being said, let's look at the fundamentals of the company. So the company has been growing a lot. For example, there has been a huge growth in both revenues and net income. Firstly, let's look at revenues. As we can see here, it's been growing tremendously over the last 10, 11 years, which is very impressive. Very few companies can grow like this. And we've also seen the same in net income. However, we've seen in 2022 and 2023 that net income dropped quite a bit, and we will cover that shortly. So moving on, as we mentioned, the company has been growing a lot, but it has a very strong brand as well. We would say it's known all over the world, and it's seen as a company that changed the e-commerce landscape in China. However, as we just alluded to in the net income statement, the financials have been deteriorating a bit because they have been making long-term investments. So basically, they have been increasing costs, which is why the net income has been decreasing, and that's affected the share price. That's the reason why the share price has fallen quite a lot. Now, given that the share price has fallen, we believe that the valuation is currently very favorable. So our prudent fair value estimate is around $160. But we think that fair value is probably quite a lot higher than that. And we are recording this video in mid-December 2023. And the share price is currently at around 70. But we invested at about 80. And as mentioned earlier, the net income has fallen, and we can see that the net income margin fell quite a bit in both 2022 and 2023. And as a result, the valuation has come down as well. So we're seeing now that Alibaba has an EV/EBIT ratio below 10, which we believe is quite good for a company that's that well known and that's growing that quickly.
Now let's take a look at how Alibaba fares for us as an investment. So Alibaba isn't the perfect example of a quality company under our new investing system because its financials have been deteriorating over the last few years, as we looked at earlier with the net income margin chart. However, this is because they are making investments for the future, investments that will hopefully create long-term profits for the company. This was therefore not the most clear-cut decision for us because we do like to see more stability in a company's financials, but nonetheless, we still believe it's a good company. And since it's not a perfect example of a quality company under our new system, we deemed Alibaba to be a tier 2 stock, as opposed to our ideal tier 1 stock. And so we invested around 2.5% of our portfolio in it, as opposed to our usual 5%. We purchased shares around the 26th of October 2023 at around $81.5. And at this point, we're treating this as a test because we want to see if investing less money in a slightly riskier stock, but at a very good price, can pay off. And speaking of risks, we'll move on to what we think the risks are with this company. The first risk would be if the Chinese government were to initiate another tech crackdown that forces Alibaba and other Chinese tech companies to start paying fines again. the government started cracking down on Chinese tech companies back in 2020 and fining them because they feared that the companies were just getting too big and had too much control. The second risk would be if the relations between China and the US were to keep deteriorating, and as a result, it affects the ability for foreigners to start investing in China. So maybe it could become illegal to own Chinese shares, and then as a result, anyone who's owning shares at the moment might need to start selling them. And then finally, there's a risk that Alibaba continues to make long-term investments that don't pay off, and as a result, their income becomes stagnant or even worse, falls. Right, and that wraps up our presentation. We hope you liked it, and thank you very much. Bye-bye.
Thank you. Bye.